And with that, you know, you have a free consultation with one of us, and we again have been extensively trained on the subject. It also comes with your basic estate documents. That means a will, a power of attorney, a living will, healthcare surrogate. If you were to go to an attorney and have those documents drawn up, they would easily charge you somewhere between $700 and $1,000 for a couple. And through the conference, whether it's Kentucky, Tennessee, or Georgia, Cumberland, that service is completely free, and those documents are provided completely free. And in fact, with that program, you actually end up working directly with the attorney. The attorney will call you, he or she or their paralegal will call you and answer any questions that you have. You know, I mean, you just can't get anything better than that. We will help you with the signing, including notarizing and witnessing, or else you can handle it on your own. So just an amazing program that is available to any member of the church, really. And with additionally to that, we have charitable gift annuities, which we'll talk about in just a minute. Remainder trusts. Of course, I hope everybody here knows about the Southern Union Revolving Fund, the SURF program, as we call it. That's a deposit program where your funds are used to build churches and schools. And so it's really a great, and plus you receive a higher interest than what a bank would pay. So it's really an excellent
talking about Southern Revolving Fund.
Oh.
Good. So Adele, next slide. Oh, okay. Talking about the charitable gift annuity. This is an amazing program. If you make a gift to the church, there's an agreement that we will do with you in which we pay back to you an annual amount. That's why it's called an annuity. An annuity means an annual payment back to you. And as the diagram shows, in number 1, the donor makes a gift to the church, and then the church pays back to the donor a fixed income, a set amount that'll never go down, regardless of what interest rates do, regardless of what the stock market does. Your payment, your payout or payment will never change. And you don't have to get it annually. You can get it every quarter or 6 months, whatever you want to do. But on top of that, because it was a gift to the church, a portion of it is tax deductible. And the amount that's tax deductible and the payout rate that you receive is dependent upon your age. So the older you are, the higher the payout rate and the higher the tax deduction is for you. So again, the payments are for the rest of your life. They'll never go down, and they are backed and guaranteed by the church. So the church would have to go out of business before you would not receive your annuity payment. So, and we all know if the church goes under, you receiving your annuity payment's probably going to be the last thing on your mind, because we know the Lord has come back at that point. So I do want to tell you, that's fine, Adele, that's great. If you're interested in the charitable gift annuity, and I'm going to refer to that as a CGA for charitable gift annuity, just contact, Silka if you're in Kentucky, Tennessee, or Ray if you're in Georgia, Cumberland, or certainly me or one of the others on our teams, and we'll tell you all about them, and no obligation, and we'll even run a model that'll give you the specifics on your individual situation. Free of charge, we're glad to do it. But if you're tired of seeing 1% and 2% interest rates at the bank, or you're losing sleep at night because the stock market is up and down and you have no idea with the next election, what's going to happen to the markets, you may want to look into a CGA. Okay, disclaimer. Neither me nor anyone on my staff, I don't believe on Ray's or Silka's staff, they can correct me if I'm wrong, but none of us are attorneys or certified public accountants or licensed financial advisors. We are certified by the NAD, but we are not attorneys, CPAs, or financial advisors. We would refer you to that particular professional for any specific questions, that you may have. So Adele, could you back up 2 slides real quick? This is the deferred gift annuity, an example of a deferred gift annuity where you defer receiving the annual payment for, however many years. We don't do very many of those. Usually they are immediate gift annuities, but certainly for, someone younger, they may want to do it as a deferred gift annuity. Okay, let's move forward.
Hi, Phil. Can I ask a quick question on those?
Yeah, John, go for it.
Yeah. Is there a minimum amount for us to start this, or is
In the Florida conference, the minimum amount is 10,000. Ray, do you have the same 10,000? Yeah.
what's the increment? Is there like a block increment, like 5,000 increment? Or is there like an increment that we do, like 10,000, 15,000?
Yeah, no, anything north of 10 is fine. We've done them for all kinds of different amounts, and yeah, whatever you want to do is fine.
Okay.
Thank you for the question, John. Really appreciate it.
I have a question.
Yeah, please.
Yes, I put it on the chat. What determined the percentage of the payout?
That's a great question, and that's based on your age. So the older you are, the higher the percentage is. Currently, and let me reach over and grab my chart, but the highest rate right now is for a single life gift annuity. If somebody is 90 or older, the rate is actually 9.7%, which is crazy. I mean, that's amazing. We haven't seen, interest rates like that in 20 years or more.
How about 65?
65 for a single life is 5.4%. And that's rounded up to 66 when you're within 6 months of your next age, and that's 5.5%. So again, very, very good. But let's save those individual questions. We would invite you to contact, again, the appropriate conference to have them run a model and show you what the tax deduction will be, and also show you what your payouts would be. So some housekeeping items: please do keep your computers muted. You never know when the dogs are going to start barking, or Amazon's going to leave a package at the door. So as a courtesy to everybody else, leave your microphones muted, and then do send any questions or comments through the chat. I think everybody these days is familiar with Zoom, but if you're not, down at the bottom, if you run your cursor on the bottom of your screen, you'll see several little icons, and one will say chat. And if you click on it, a little box will come up and you can type your question there. So very good. Without any further ado, I would like to introduce my friend Jose Acosta. As you can see here, he's been working in the financial services industry for over 16 years. He's earned multiple awards and is currently a member of the $1 Million Roundtable. And Jose is just a good guy. He's one of us, and glad to talk with you about, he understands Adventist concerns. He understands Adventist goals and priorities. And Jose, if you're with us, without further ado, let me invite you to give us your presentation.
Perfect. Thank you so much. Let me share my screen now. All right. So it so happens, Phil, that a lot of what I'm going to discuss, we will touch on annuities. So that's going to be a good thing. And I'll talk about the difference between the annuities you get at the marketplace and the gift annuity that you're talking about as well.
That would be very good because I'm curious about that. Can you turn your volume up any, Jose? I can hear you just fine. But it'd be even better.
Let me see if I can. How about now? Can you hear me okay?
Yep. Yep.
Okay.
Good.
Perfect. So today I wanted to discuss income streams. And the reason that I wanted to discuss that is, you know, we work all of our lives in order to retire. And the one big factor that will dictate when we can retire is income, right? So we save money in different assets, whether it's businesses, equities, 401ks, whatever it may be. The idea is that one day we have enough assets to be able to stop working. And that happens the moment that we can create enough income so that we don't have to go to work if we don't want to. Okay, that's kind of like when you win, if you have enough assets to have income and not have to go to work, you are set. So that is why I wanted to address income streams. So today's presentation is meant to just give you just an overview and a working knowledge of how to start structuring income streams. It's really meant to give you information that you can go and work with your financial professional with, right? To start organizing yourselves for income streams. We can't really cover every angle, but it's going to give you a good working knowledge. And that's my goal. So, retirement income streams. There are three different phases of retirement planning that we talk about in the retirement planning world. And these are one, accumulation, right? So this is a time where you are working, saving, and growing, right? So you're putting away money in different retirement accounts, savings, or investing in your business or real estate or whatever it may be. So you're just kind of putting away money while you're working, okay? And that is the name of the game in the first phase, accumulation. Then we hit the pre-retirement prep stage. And this is where now we get closer to retirement time. And this is when we start to now take a closer look at income streams, the stability of your assets, how market affects them, interest rates, different things, right? So we start to think a little bit different because we are getting closer to retirement. And I call this the pre-retirement prep time. Then, and this is about 10 years before you retire normally. Then we deal with post-retirement. So this is the time when you are actually taking income, okay? And the reason I wanted to kind of break this into three different sections is, first of all, we're going to be dealing mainly with the pre-retirement and post-retirement. And we talk about different risks and we deal with different things at three different stages. So they are all very different. So again, we're dealing mainly today with pre-retirement, prep, and post-retirement. Like I just mentioned, there are different rules, right? So when we're dealing with accumulation and distribution, it's almost like two totally different games, right? In accumulation, we're just trying to grow, right? And save as much as possible. But with distributions, we're trying to protect. We're trying to protect our assets. We're trying to establish income streams, ideally for life, right? We're dealing with longevity. We're dealing with inflation. We're dealing with legacy goals and different things. So very different stages, different rules. There are several risks that are particular to these stages, which we are going to address today and talk about some of the ways that we address these. Now, something I will not be dealing with today will be taxation. So taxation and specific investment strategies, I think those things are best stayed for an accountant. And also for, you know, one-on-one with your financial professional, because everybody's situation may be a little bit different. So the first step in setting up income streams is going to be identifying your sources of income, right? So kind of figuring out what assets are the ones that we're going to use for income at retirement. So let's go over some of the more traditional sources of income that everyone knows. So one of the first things that come to mind is Social Security, right? So we are all putting money into the Social Security system so that at retirement time, we do get a payment from them for the rest of our life. Social Security is a big part of retirement planning. That is a traditional source of income. Then most people have some type of retirement plan at work. So they know it as 401k, or if someone works for a nonprofit, there are the 403Bs, 457, thrift plans for those that work on their own IRAs, right? So everybody's familiar with these types of accounts. That could be another source of income, of course. Then for those that own businesses, sometimes the sale of a business or being able to step away from your business and provide an income from it, right? So I'm working business and getting income at retirement time. That could be another source of income. Then we get to the non-traditional sources of income. So these are the things that normally just come to mind right away when it comes to income streams. And these could be things like anything other than your retirement account. So it could be investment accounts somewhere else, savings accounts, and different things outside of your retirement plans and work. Then you have real estate, right? So some people may own properties that can be sold and turned to income. Some people may own rental properties where they can get rentals, rental income, right? So real estate. Part-time work can also be thought of as a source of income, right? So and that'd be a way to get keep busy and provide income as well as retirement. Another option is a reverse mortgage. So tapping into the equity in your home while you're alive and set that up to give you an income stream also. So that's called a reverse mortgage. Once we identify the sources of income, the next step is to then start putting together a budget. Okay, so putting together a budget to see what are some of the things that we call essential expenses and discretionary expenses. So in this approach, and there's many ways to set this up, but the one that I use is the flooring approach. And what this is we are going to identify what our essential expenses are every month, and that is going to make up our floor. Okay, so we're going to create income streams to address our essential expenses. That's the idea. So again, identify essential versus discretionary expenses. For most people, the hierarchy of need will go something like this. So number one, you've got your essential spending needs, your food, utilities, things of that nature, things you can't live without. Then you have your emergency funds, so money that you put away to be able to tap into in case of an emergency or things like going as planned. Then you have your discretionary expenses. So this will be things, that dream vacation, that dream car, different things. And then legacy goals. What are you leaving behind, right? For the next generation, for a charity. And that gift annuity that we talked about in the beginning would kind of fill some of these needs, right? So that's where the gift annuity comes in. So again, the essential items will make up what we call the floor. And we meet these needs with streams of income, ideally, that have low volatility. This means that these are going to be less affected by things like market and risk. Okay, so things that we can count on. Okay, that's what we mean by low volatility streams of income. And the discretionary expenses, right, your vacation, etc., those can be met with a well-diversified portfolio, right? So these are things that we can ideally invest and grow at a higher rate than inflation. So that's the second part. Now let's take a look at some of these sources of low volatility income. Okay, again, Social Security, that is something, as we all know, the moment that we retire and we take a Social Security payment, that is a payment that is set for life, right? It actually can only increase, it cannot decrease, which is good. So it's a great source, a great thing to plan around. So you want to work with someone that understands Social Security. You want to look at your statement so you know what you're getting, because this is a great planning tool when planning your income stream. It's probably the first thing we look at when planning income stream, Social Security. Then we have income annuities. Okay, so annuities are tailor-made as a low volatility option because they're made to just give you income. This is really where they shine. Okay, so an annuity, in a sense, like Phil explained in the beginning, is an exchange of a lump sum for an income for the rest of your life. Okay, so this definitely will help us meet that floor of essential needs. So income annuities. Again, rental income is another source, right? So that takes a little bit of work, but if you have a tenant in a real estate property, you can get rental income. And again, this is another source of income that can help you meet that floor, right? So that those essential expenses. You can also do this with equities, though then you lose guarantees. But if you have a portfolio that's geared towards stability, towards income, right? Then it could be done with equities, right? But that's probably my least favorite option of these right here. Now, like I mentioned before, the options for discretionary expenses are going to be mutual funds, stocks, ETFs, and there's many other investments, businesses, different things. And the idea would be that if these investments can outpace inflation, then we're good, right? And these are meant to supply our needs for discretionary expenses. Now, for those that are more of a conservative bent, there are some annuities that are made for growth. And basically the way they work is you put in a lump sum, they guarantee your principal, and they give you a portion of market gains. Okay, so you can make money with the market, but you never experience a loss. And after a set amount of time, the money is now liquid and you can do something else with it. So think about like a jumbo CD, like a long-term CD. So there are annuities that do that. They are meant to beat inflation and give you better rates than maybe a bank while protecting your principal. And that can be used for discretionary expenses if you want to be very conservative. Now, I also wanted to address some of the risk to your retirement income stream, okay? And then one of the first things that comes to mind is a sequence of returns risk. I know that I attended the webinar, I think 2 webinars ago, and we definitely discussed sequence of returns risk. So I'm going to explain what that means here. So the sequence of returns risk is explained like this. So investment returns become more important as your as the portfolio gets bigger. Okay, so investment returns affect your portfolio as the portfolio gets bigger. And for most people, your portfolio is biggest right before retirement time. Okay, so obviously a negative investment return during this time is going to have a huge effect, not only on wealth accumulation, but also retirement income success. So think about it like this. If you have, if you have a negative return, let's say you have $100,000 and the market goes down 20%, you're now down to $80,000. Let's say the market rebounds back 20%. From that 80, you only get back to 96. So it actually takes a bigger jump to get you back to where you started from a negative return. And if you are taking income during this time, that just compounds the damage. So you can see how having a negative investment return as you get closer to retirement time and as you're getting close, or if you're doing the time of income, can be catastrophic to your retirement income success. So this is the sequence of returns risk. And this is something that we seriously have to deal with usually about 10 years before retirement. That's kind of like the retirement danger zone. So it's important to manage this risk during this time, right? Because if you have a negative downturn in the market, and if you don't have the time to recover before you take income, that can be catastrophic to your chances of successfully providing income at retirement. So what are some of the ways that we address the sequence of returns risk? So once you get to that 10-year mark, one step will be reallocation of equities. All right. So this time, instead of looking for maybe risk and growth, we are now looking for stability, looking for income, right? Dividends, things of that nature. So we're looking for more stability. Designating a portion of your assets for income, right, opens the opportunity for an annuity. And there are many kinds of annuities. I know Phil explained one type, but they're mainly all made to give you income for the rest of your life. Okay, so this is one way, and the one that comes to mind for helping prepare against sequence of returns is there are some deferred annuities where you put a lump sum in, and they are no longer being affected by market. They give you predetermined increases, and at some point in the future, you have an income for life. So that is a way that we can eliminate risk, specifically the sequence of returns risk, using deferred annuities, okay? Then we want to deal with longevity risk. And for that, we have to understand life expectancy. So statistics say that with the advance of medical technology, people are now living longer and longer, right? According to the Social Security Administration, people are expected to live between 84 to 86 years old. Of those people, 1 in 4 will make it past 90, and then 1 in 10 of those make it past 895. So that could realistically be 30 years after retirement that we have to worry about income streams. So that is a longevity risk. And the way that we address this, of course, is by having things that will provide income for life. Understanding using a tool like Social Security is very important, because the longer you defer taking Social Security means that your payments increase. Okay, you can do that all the way up to age 70. Okay, so that is one way that we address longevity, because once that payment is set, it is set for the rest of your life. Again, Social Security. Again, lifetime annuity payments. There are some plans at work that will give you an option to get a payment for the rest of your life using type of annuity. Okay, so you choosing that option can be a way to address for longevity. Another option is using a lump sum of money to purchase an annuity outside in the marketplace. Okay, that could be an immediate annuity, which means it gives you an income right away, or it could be a deferred annuity, which is the one that would give you an income at some future time. Okay. Also using, for those that have permanent life insurance, some of these plans actually have cash value inside, and that cash value can be transferred to an annuity with no tax consequences. So it can be turned into a lifetime income using the cash value inside a life insurance policy as well. Here again, we can discuss things like a reverse mortgage or rental income. Okay, so these are steady streams of income that can be set for life, that can help us deal with longevity. For those that do have a business, again, having a business that can work while you're not there and provide an income for yourself, that is the ideal situation. It's a very good thing to have. I did want to share with you something today. that by Tony Robbins. So back in 2016, Tony Robbins, which is a very well-known motivational speaker, wrote a book called Money Master the Game. And basically what he did was he interviewed some of the most famous, rich, wealthy, successful people in the money world to ask them what the secrets were to success. And it so happens that he mentions a lot of the things that we talked about today. And he talks about income insurance and how annuities fit in this plan. So I did want to share that with you today. It is a 10-minute video. I think it'll kind of put a lot of things together that we talked about today. So let me bring that up real quick. And here he was doing an interview talking about the book and talking about the step for income for life. Okay, and this is where the annuities come in.
I think you need to share your audio as well from your computer.
Yeah, we cannot hear.
Oh, okay. Let me I'm not on mute. Let me
When
do I
you,
put myself on mute.
yeah, when you did the share screen, there's a special button that says also share audio.
Let's see.
So if you did not click that, you'll have to stop sharing and then go
And start
back
again.
and click that, I think.
All right, so let me stop sharing.
Mhm. Go back again.
So share screen. Come back to the screen again. Share. Let me see. Hold on a second.
Usually it's in the bottom left-hand corner. It says share audio.
I only have the mute button. Let's see. I don't see that.
It should be on the screen before you actually start sharing. It's the screen that comes up that shows the very beginning of your share screen.
Let me see. Okay, so I only have the new share, which then takes you to this screen here. And then when I play the video, you don't hear anything?
Yeah,
No.
no, we don't hear it. No, we don't
Nothing,
hear it.
right?
So let me see. Share. No, I don't see it. Mm.
He could share his screen with you and then you could direct him from there, Adele.
Yeah, I don't see here on my side either. So let me try again. If I go to share. Mm.
You know what I can do? I can put the link in the chat and everyone can watch it later on. I'll go over some of the details of the video. Unfortunately, I guess you cannot hear it.
Well, there's
Yeah.
always technical troubles, you know, they're
Yeah,
frustrating.
I don't
but they
see.
happen.
I don't see the way how to share the audio.
Yeah, that's
Mm,
okay. I
so
thought maybe
it's
what I
okay.
was hearing on my microphone, you will be hearing it too.
Yeah, no.
That's okay. All right.
Okay, so let me stop my
Okay.
sharing.
So I'll put that in the link. I'll put that in the chat box.
Sounds good.
Basically,
I
yeah.
wondered if he could just play it and not share screen and then we can hear it.
Let me see if that
We can
works.
try that.
Yeah, when
You
you
hear
click,
that?
Yes.
Oh, okay. So that would be the same thing. So let me go back. Okay, it's really the audio that we want. So
I'm not hearing anything now.
no,
Nope.
okay, that's okay.
yeah, when you
Uh,
when you click on share screen, there will be like a panel of different screen that different window you want to share. But before you click on that, at the lower left corner, there's a button there called you
Oh,
want to
yeah,
share
yeah, yeah.
audio.
I got it. I found
Yeah.
it. Okay, perfect. Thank you so much.
Yes, sir. On the bottom, say share sound, optimize for video click. So share
I
sound.
got it. I got it. Okay, so let's do it again. That should be good now.
On their model.
Yes, of what
which
they've
is
already
right
proven.
there.
Yes.
What's the next step?
Next
Great.
step is you've got to create an income for life. And then when I say income for life, it's so interesting because I ask people all the time, why do you invest? What are you investing for? What would your response be?
So I'll have money when I'm old.
Right?
Yeah.
So some people say, so I have money when old. Some people say, so I can grow my assets. Some people say, so they tell me all kinds of things. There's only one reason to invest, income. You can have all these companies, but eventually you have to convert that to income to be able to live a great life. The final purpose of all investing is income. And most of us don't know that anymore because all of the marketing machines of the large banks, if you are taking income, it's no longer in their account.
So it's bad.
So it takes it away from
Yeah.
them. So one of the things that I looked at was, I started looking around, and most people know the power of life insurance, right? Don't like it, but I want to make sure if something happens to me, my family's taken care of. But what if you live? And here's what's crazy. The number one fear amongst baby boomers is not death. Death is a far number two, way down the list, number two percentage-wise. Number one is running out of money before they die, having a life where they don't have income. And it's going to happen, according to all the statistics, to about 75% of the population, right? It's mind-boggling. So what do I do without any income? That's why you see people now in their 70s as greeters at Walmart. You know, it's just they got to figure out what to do because they never figured this stuff out in the beginning. So there is income insurance. Income insurance is old. It's a 2,000-year-old approach to making sure you have money. Julius Caesar was the first one who created it. And here's what it was. They created a pool of money where the soldier's going to go out. And everybody put their money in, and it was held by the government. And whoever came back, they split up that pool of money over time with annual payments. So the word annuity that we all have heard, the word annuity is annual payments. Now you get annuities that pay you every month, but that process that's out there is one of the most successful opportunities for people to create an income. In other words, there's a stage in my life where you build, like you are. You're grow, and you're going up the mountain. You're saving, you're investing, and you're building it to a giant critical mass, to a jackpot. When you get to the top of the mountain, there's going to be a stage where you're not going to want to work. You probably will. Guys like you and I will always work. You don't have to work, and therefore you tend to work harder.
I couldn't imagine not doing it.
It's just like I couldn't either.
Yeah.
Steve Wynn's a dear friend of mine. He's 72 years old. He works harder now than any time I've known him. Just crazy. T. Boone Pickens is a friend of mine. He's 86. When he was 68, he retired. He's a billionaire. He's made more money after coming out of retirement in the last 15 years than he did in the first 68 years, and he's having the time of his life, right? But you want to know you don't have to work. So when you get to that peak where you have enough money, now you want to be able to ski down the mountain, enjoy your time with your family, do whatever you want to do, give your time, your energy, your capital, do whatever you want to do. That phase you need income for. And most people aren't planning for income. So you could be in a position where you built your assets up, your stock investments, your bonds, your real estate, and how fast can that drop by 50%, by 30%? We've seen it in every market.
About a nanosecond or
Ray
a
Dalio.
day. Yeah.
Ray Dalio says point blank, he said, whatever you invest in, most people invest in something they feel is their favorite. They think they know something about it. So he said, you're a real estate guy, you put all your money in real estate. And then you put all your money in stocks, or you put it into commodities, or whatever. He said, whatever investment you invest in, he said, mark my words, in your lifetime, there will be a day that category will go down 50 to 70%. He said, so the only way you protect against that is asset allocation, spreading out against many different baskets, not one. And the other way is you create an insurance policy that says, I'm guaranteed a certain income for life. So what you do is you take a percentage of your earning and you put it in an environment where it grows. And the only problem with that is I heard annuities and I was like, annuity to me was the most negative word. It was like,
I know you think about some sleazy insurance sales.
yeah, exactly right. So you associate to it.
Yeah.
But here's what an annuity is. Bernanke, as the head of the Fed, his top 2 investments were both annuities. Because I used to read these ads that say, they still market them. It says, what does it say? It says, I hate annuities and you should too. Yeah. And of course you go to it and it's a guy that's selling you stocks, right? And he says, oh, annuities, they have all these fees. And he's right. There's tons of horrible annuities, just like there's tons of negative mutual funds. There's tons of people who got fees everywhere. They take it every year. And the annuity side, there's a commission paid to a guy. He gets paid once. So I want to be really clear. Annuities aren't a great product. Like mutual funds aren't a great product. The right annuity, the right investment is the right one. And that means you've got to be able to strip out all the crazy fees. You got to know what you're getting. And for most people, that's complex. I'll give you a perfect example. A variable annuity, very popular annuity, is filled with fees. It's fees on top of fees. It's fees to be inside of the annuity, and then there's fees for a mutual fund on top of it. It's a disaster. But there are types of annuities, like done properly, like these hybrid annuities, they call them, where it's tied to an index, meaning a stock market index. So here's how it works. You get the upside without the downside. If the stock market goes up, you get a percentage of that growth. If it goes down, you lose nothing. So like you think about my friend who's been out of the stock market for 6 years and he's got nothing to show for it. I said to him, this would have been one of many different vehicles you could have easily done. And what's beautiful about these types of annuities, when it's the right company, you want a company that's got the right rating. You want a company, these insurance companies, the good ones have been around 100 years, 200 years. They've been around since recessions, depressions, the 2008, and nothing's hit them. They're that strong. They've been around. That's all they do. And I said, so with these types of them, there's some that are available. Most of them are available only for people in their 50s and above. So it's thought of as, something for grandpa. I sat down when I started seeing all these work. There's one annuity I saw, and I'm getting old enough that I'm within the range of doing these things now. It just scares me. But one of them gives a guaranteed return of 7% a year. And where are you going to find that? And
my immediate reaction.
That's impossible.
It's like,
I know. It's a company that's A-rated. It's been around forever. But here's how they do it. You pay into the company, in this particular one, your rate grows at 7% a year, and then you have this lump sum. You don't take out the lump sum. That's how you get the 7% per year. What you do is you take out 5% of it a year. And so they show you what that means to you in income. Because what you really want is income. Mm-hmm. If you're in the stock market and it drops 50%, your income is just cut in half, and then to grow it back can take decades. So there's some that are tied to the stock market. There's some where annuities that are available today, brand new ones, where I saw this one, it blew my mind, where you take the upside of the stock market and they take what's called a spread. So they'll take 1.5% off the top. So if the market goes 10%, you got 8.5%. If it goes 20, you got 18.5%, right? Mm-hmm. And if it loses money, you lose nothing, and there are no fees if it doesn't make money.
That's a much more attractive proposition.
It's mind-boggling. And then they have a second piece which says, if you leave your money with us and you don't take it out, if you leave it with us, then you can convert that to income in the future. And we can show you how much that would be worth in the future at different stages. So you're able to have something to plan with. So I'm talking about a subject that's really complex. I'm realizing I'm trying to explain this in a few minutes. And I haven't tried to do it verbally. I do it in the book and really step by step. But take it this way. If you knew today that you could put a certain amount of money aside, and instead of wondering how the stock market was going to go, you knew that meant for you $5,000 a month, $10,000 a month, $20,000 a month, whatever it is, for as long as you live, and that even if all the money you put in, you'd outstripped, you'd still be receiving the money. That's what you get in these types of income insurance plans. And the way they do it is, some people live very long. Today, people Social Security was developed, 1920s, 1930s, right, under Roosevelt. 65 years old is when you're supposed to get it. Well, the average lifespan was 62 then.
Yeah.
So it was for the outliers that were being taken care of. And it was to make sure in your older years, 3 or 4 or 5 years of retirement, you'd have some money to be able to live your life, be with your family. Well, today, people living, 85 years. So at 65, they've got 20 years of retirement and they have no plan. And that's the average person, right? If you're married, one of the 2 people in your marriage, there's an 80% chance they'll live to 92 years old. So we're living longer and longer, and technology is just being started to really be brought to it. And yet we work for 30 or 40 years, and then we're supposed to have enough money for 30 years or 20 years. Most people don't have it. So these types of programs that I explain in here step by step, these programs can give you the income for life so you don't have to ever run out of money. when I was with a gentleman by the name of Jack Bogle who started Vanguard, and Vanguard is, the largest mutual fund in the world, but it's an index fund. So they charge very, very small fees, 20 basis points. That means 0.20 when you use basis points, by the way. There's a lot of jargon in this industry. I said to him, I said, I know you believe in investing in the market. I said, but there's a dirty little secret. And the little secret is called sequence of returns. That if you work and you build your whole life up to get this nest egg, and now it's large enough that you can invest in a secure environment and have income coming back to you. It's like your money machine. You don't have to work. But then the market takes a hit, then it can make a huge difference in where your income is. I said, versus if you have a contract with an insurance company that guarantees you that income, and the company's been around 100 and whatever years, or you diversify amongst multiple insurance companies. I said, those have been proven over hundreds of years to be successful. He said, that's true. I said, the whole dirty secret is, if I'm investing well in the first 3 or 4 years of my retirement, the stock market's up, I might have millions of dollars over the course of my life. If in those first few years it's a 2000 or a 2008 and the market drops 50%, I can show you statistically, you never get back to where you need to be based on your age. So having a balance of assets and having some of these, insurance policies where I know what my income's going to be is the fifth step. It's really making sure that you put the balance in. In a different stage of life, you're going to be focusing on this more. I actually went.
So you see how you have some of the most famous, successful people in the world and the world of money and finances talking about how an annuity can be one of the biggest factors in ensuring success with your income streams, right? It helps to fight against longevity, sequence of returns. So you see how it all ties everything, basically a lot of the stuff we talked about today. So let me get back to where I was before and share my screen. So I did learn something today with that. Share your audio. Thank you so much for that tip. All right. Okay. So we already addressed then longevity. And the next thing we're going to discuss is inflation, right? So we addressed longevity, sequence of returns. So for inflation, I was playing with the calculator from the Department of Labor, and I was asking, if I had $100,000 in the year 2000, how much would I need to have today to have the same amount of purchasing power? And I would have to have $178,000 today to have the same amount of purchasing power that I had back in 2000. So that's an example of inflation. So this is where we use investments that are tied to market, because traditionally they do outpace inflation, right? So this is one of the ways that we create an inflation hedge and deal with inflation risk. There are some work plans that give you higher benefits for, let's say, working longer. So one of the things that comes to mind is, for example, the Florida retirement system. If you have, if you work for the state or school and you work for a certain amount of years and you accrue service years, you get a higher benefit. So that's a way also to deal with inflation risk by locking in a higher amount or a higher income. Another way to do this as well is to use earnings from good investment years to buy additional income or deferred income annuities to give you an additional income for later on during your retirement years. That's another way to do that as well. And Social Security payments. So one of the things that Social Security has is that it is inflation protected. It goes up based on cost of living every year. So the longer you wait for Social Security, it actually means that a higher percentage of your total income is protected against inflation. So again, Social Security is a very good tool to understand because it has many, many benefits. In this case, it does have inflation protection built in. The last thing I wanted to discuss today was healthcare risk. Okay, so medical expenses, the cost for medical expenses are going up and up every year. So this is something definitely that needs to be planned on. For anyone that is retiring before age 65, one of the things that you want to find out is what your health coverage options are. For example, how much will Cobra cost at work to keep your benefits from your health benefits from work? Can you take health insurance from your spouse's work? Okay, is that an option? How much is that? Or if you enroll through the exchange, how much would that option cost, right? Because you need something to cover you from early retirement to age 65. And we say age 65 because at age 65, you are now eligible for Medicare. You do want to work with someone who is a Medicare professional. I believe that our next two webinars deal with Medicare, which is great because you want someone that understands the options, that can help you choose the right option and coverage. And another source of a good referral for Medicare will be your financial professional. Then you also want to think about long-term care. Long-term care is defined as services that include medical and non-medical that are provided for people that are unable to perform your basic activities of daily living. Things like dressing, bathing, eating, toileting. And this can be done at home, in an assisted living facility, or at nursing homes. Contrary to popular opinion, Medicare is not covered, long-term care is not covered by Medicare. Okay, so it's something that needs to be planned on separately. Medicaid does have some long-term care provisions, but it does require you to spend all your assets and basically become impoverished in order to be able to get Medicaid. So the government would have a plan for long-term care. Most people are not going to like it. Okay, so that's for long-term care. Now, back, say, maybe 10, 20 years ago, there would be insurance plans for long-term care. They would give you a daily benefit for that expense. And these were usually purchased in the 50s, because it's usually when they give you the best value. But one of the issues about with these plans was that if you did not incur long-term care expenses, you would not get another benefit from it. So what the industry has done now is that they have these hybrid plans, okay? So there are now things like annuities that say, we'll give you an income for the rest of your life, but if you need long-term care and are in a qualified facility, we double your income, let's say for the next 5 years. So that's great to have because then it covers multiple needs. There are now life insurance policies that say you have a life insurance policy, but if you're ever in a long-term care situation, your death benefit now becomes a pool of money for long-term care. Okay, so there are ways to address this need, whether it's a particular insurance policy or having hybrid products that also take care of this as well. I did want to address healthcare because healthcare, again, it has become so expensive, it can really put into danger your income streams and your assets if not properly planned for. So I hope that you were able to get some good, valuable information today. I mean, it's hard to cover every facet of retirement planning in one shot, but this is meant to give you just some working knowledge for you to be able to take your financial advisor or financial professional and be able to work together to become, to create income streams. So with that, I am going to open it up for questions.
Outstanding presentation, Jose. Thank you. Let's
Thank
keep it a
Jose,
virtual
I'll ask you, Jose.
Yes.
I appreciate what you presented. I learned a lot. Let me ask you to address what the flip side of annuities, and that is, what are maybe one or two, and we're about out of time, so just briefly, but what are one or two of the issues or downsides of annuities, and how do you mitigate those, or what are your thoughts about that? Because sometimes those can have a bad reputation.
Yes, for sure. And I think because there's so many different types of annuities, so much misinformation, you do want to be careful who you work with. But the two biggest downsides of annuities are, one, they don't provide much liquidity. So once you're set, right, with your income amount, it's you can deviate from that, but it breaks the contract and it has negative consequences. So basically, they're just a way to set up a payment for the rest of your life and you're set. Okay, so not being liquid is an issue. That's why you want to have other assets that provide liquidity. You never want to put all your assets there, right? So in my approach, we take an annuity to help to provide money for that floor, right? So for our essential expenses, number one. Number two would be inflation. So again, we set an income for life, but it's set, right? And remember, as inflation goes, your money is worth less and less every year. And that is why a portion of your assets gets invested in other things, right? That can serve as an inflation hedge. So downsides, it doesn't help with inflation, and it does not provide liquidity. That is
So-
why you want to work with a professional.
So when you pass away, is the money lost, or can you name beneficiaries?
So you name a beneficiary, and I'm glad you brought that up, because that would be the main difference between, let's say, the gift annuity that you guys discussed, right? So with the gift annuity, you still provide that income and it's set for life. The beneficiary becomes your charity of choice. And the annuities that you buy in the marketplace, you achieve the same thing, except the beneficiaries would be the person that you leave, or whoever you want to name, right? And then you get the remainder of that lump sum.
Okay.
Can
So
you
you
do
don't
it?
lose-
Can you?
So you don't lose the money.
Correct. You don't lose the money.
Can you do the annuity for 2 lives? Or this type of annuity is just only for 1 life?
You can. You can do the 2 spouses, so the income would continue for the life of 2 people.
Will that give you a lower rate compared to one life or 1 person?
Yes, yeah, of course it does, because then they have to give you income over 2 lives.
Well, we're at 7 o'clock and maybe even a minute after, and I like to respect people's times. So, Jose, this was very informative. It really, really was. I've been in and around the financial services industry for about 15 years, and I learned stuff tonight. So thank you for that very, very much.
You're welcome.
Very
Thank you
well
for the kind words.
organized, very well presented. Nice job. So thank you for that. I do
We
want
need
to
to have
mention,
Jose's information, please.
yes, Jose, do we have a slide, Jose? There we go.
Yes,
Let's see. So
There you
if
go.
anybody would like to ask Jose a question directly about their particular situation, there's his contact information. Take out your phone and take a picture of this slide or jot it down real quick. You see his phone number. And I assume, Jose, that you could work with anybody, because we have people all around the state and even beyond.
Yeah.
So you could either help them or refer them appropriately.
Correct, yeah, I'm licensed in multiple states. So, I can help.
And,
Thank
and
you,
you don't,
sir.
and you don't mind questions, and no matter how inexperienced the question may be, you're happy for it.
I don't mind questions at all.
Okay. So I'm going to mention again, because I am so excited about the August 29th and then immediately the following week later, September 5th, the Medicare workshops, part 1 and part 2. Very excited about that. I didn't mention in the beginning that each of our trust services department is just really thrilled. This is a ministry to us. There's no charge for our services, and we would love to help you. I cannot tell you the number of testimonies that we have of church members that have gotten so much, not just their will and their power of attorney document. That's the basic. but there's information that we can provide on how to avoid probate or how to qualify for Medicaid without having to lose all your assets. There are things that we would love to share with folks, and we're here for you.
Phil, I would love to encourage everybody to participate in these 2 workshops about Medicare.
Mm.
The presenter is going to go in detail about how, depending on your needs, which plan you should choose, the pros, cons, about the ads that you see in TV that offers you great things, but you don't see the fine print. So he's going to educate you in detail these 2 workshops. So I will encourage everybody to not only you come to the presentation, but share this great information to your church family members, because it's free and it's just to educate. We are not gaining anything here. It's because we have the burden to educate our family, our members, our church family.
Amen. Thank you for that. Silka, would you be willing to unmute and have a prayer with us? And actually, before we do that, we had a question on the chat, Adeli. How could people get access to a recording of this?
That's a very good question. Please send me an email and I will send you the link. And the email is either this one, plangiving@floridaconference.com. Take a picture, or you can use my email directly, adeli.galvis@floridaconference.com.
Very good. All right. Any other questions? Please contact us directly. Again, this is our ministry. This is what thrills our heart. So we're happy to help. Here's our contact information, Ray's and Silka's, and I know that they share the same burden that we do and would love to help. Silka, any final comments before you close us out with prayer?
I just want to thank Florida Conference for arranging this, and thank you, Jose Acosta, for being willing to have these talks and do these excellent presentations. It's been so helpful to me, and I'm referring people to you as well. So thank you for all you've done. Okay, let's pray. Heavenly Father, thank you so much for the time we could spend together to learn more about how to live in this world. You asked us to be smart, and you asked us to use our brains to make the best out of the time that we're here. And we're not only here just to benefit ourselves, but to benefit our families, and for the work that you've placed on our heart, the things that you've placed on our heart to support. So thank you, God, that you give us this opportunity to be educated, to make smarter decisions, to ask for help, and to know where to find help. And please bless everybody here that's on this conference call, on this webinar, and let us come back together in August. Thank you so much. In Jesus' name I pray, amen.
Amen. Thank you, folks, so much. We hope to hear from you. Jose, thank you.
Thank you so much. Have a good night. Bye-bye.
Thank you. Okay, have a good night.
Night.
Thanks.